Hey friends, welcome to Nano Bar. Today let's talk about a century-long debate. Do you also feel it? This AI wave, this sense of déjà vu, is just too strong. Flashback to 2000. Pets.com's sock puppet was bouncing around on TV, Webvan's warehouses were empty, and then boom, the dot-com bubble burst. Fast forward to 2025. Nvidia's market cap has touched 4 trillion, and OpenAI's Sam Altman and Nvidia's Jensen Huang are talking about hundreds of billions in infrastructure projects. This frenzy feels exactly the same. So, the savviest fund managers on Wall Street, who manage nearly $5 trillion in assets, are frantically copying homework. They've pulled out a yellowed secret manual called the 2000 Playbook. They believe they can use a 25-year-old map to navigate this new AI gold rush. So, what exactly is going on? Is this playbook still useful? Or are they fighting a new war with the mindset of the last war? Let's first break down the first layer. Where does the old map get its confidence? What's different this time? We first need to understand what's different between 2025 and 2000. First, there's profitability. In 2000, that bubble was built on hope and eyeballs. At the peak of the bubble, only 14% of internet companies were profitable. The logic then was, get users first, worry about making money later. In 2025, this AI wave is led by profit beasts like Microsoft, Google, and Meta. More importantly, they are building and profiting simultaneously. AI monetization is happening instantly. Large cloud service providers or hyperscalers invest in AI and immediately see returns from cloud services. Next, let's look at who is paying the bill. Is it retail venture capitalists or giant internal funds? In 2000, the money to build the internet was borrowed by thousands of startups through IPOs and junk bonds. Many companies were heavily indebted. In 2025, the AI arms race is almost entirely driven by a handful of cash-rich tech giants funding themselves. Microsoft, Meta, and Google plan to invest over $320 billion combined in 2025. They are investing with their own free cash flow. Finally, the risk has changed. Is it a bankruptcy crisis or a return on investment crisis? The risk in 2000 was insolvency. Startups burned through their cash, and the game was over. The risk in 2025 is a return on investment crisis. In plain language, this means Microsoft spent $80 billion on AI, only to find that these AI tools don't significantly improve productivity. This isn't a risk of bankruptcy, it's a risk of massive capital misallocation. Next, let's break down the second layer. The first move of the 2000 playbook is selling shovels. All right, let's see what's written in that old playbook. Strategy 1 is the pickaxe and shovel theory. This originated from the 19th century gold rush. The ones who truly got rich weren't the miners risking their lives for gold, but the suppliers who sold pickaxes, shovels, and jeans to all the miners. This was a surefire business. In 2000, the shovel was Cisco, which provided the pipes of the internet. In 2025, the shovel is Nvidia, which provides the GPUs, or AI computing cards, essential for the AI revolution. However, this playbook has a fatal flaw. The selling shovel strategy is not safe at all in 2025. It is precisely the most dangerous strategy. Why? In 2000, the shovels were bought by thousands of retail gold prospectors. In 2025, only a few supergiants like Microsoft, Google, and Meta are buying Nvidia's shovels. These giants spend tens of billions on GPUs based on a belief. They firmly believe that AI will ultimately bring huge returns on investment. But real data slaps them in the face. Research from MIT and McKinsey shows that up to 95% of generative AI pilot projects fail to deliver measurable returns. Friends, do you understand? If this lack of return on investment continues, those giants will stop buying shovels. At that point, the first to collapse will be Nvidia, the shovel seller. Let's break down the third layer. The second move of the 2000 playbook is passing money back and forth. Strategy 2 is revenue is king, reject hype. The playbook says, don't buy companies that only hype concepts, meaning AI-embellished companies. Instead, buy companies that genuinely have AI revenue, meaning AI-driven companies like Microsoft. In plain language, this means don't buy pets.com. However, the fatal flaw of the playbook is focus on revenue. Sounds solid, but what if the revenue itself is manufactured? Experts at Yale University discovered a disturbing network of transactions, which they call circular financing. For example, using kitchen accounting, you, meaning Microsoft, invest $100 in your roommate, OpenAI. Your roommate, OpenAI, then turns around and uses that $100 to buy $100 worth of kitchen usage rights from you, meaning Azure Cloud Services. Finally, you record in your ledger, this month's kitchen revenue is $100. See, no money moved, but both your performances went up. This is strikingly similar to the notorious vendor financing scam in the 2000 bubble. So, the second move of the playbook, which is looking at revenue, might also be failing. Next, let's break down the fourth layer, the cockroach theory, who will survive to the end. The core of the 2000 playbook is to help you avoid the next Pets.com. Pets.com's demise in 2000 was due to a fundamental flaw in its business model. It sold dog food, and the shipping costs were higher than the dog food itself. It lost money on every order with a negative gross margin. So, who will be the Pets.com of 2025? Look at those wrapper companies, for example, Perplexity, AI. It's seeking funding at an $18 billion valuation, which is 180 times its annual revenue. Remember, Pets.com back then was only 50 times. Why will it die? Because it has no technological moat. It's just a beautiful shell built on top of others' models like Google's or OpenAI's. Once Google decides to freely replicate all its functions, it will instantly become worthless. So, who will win? Let's talk about the cockroach theory. Cockroach stocks are not companies that survived the bubble, but rather those that thrived in the chaos and devoured the corpses of failed companies. The cockroaches of 2000 were Amazon and Google. Why did they win? The answer might surprise you. Because they cheaply utilized the ruins left by the previous bubble, the overlaid dark fiber networks of bankrupt companies. So, who are the cockroaches of 2025? The answer is simple. Precisely those companies that paid the bill to build infrastructure during the bubble. Microsoft, Google, Amazon, and Meta. This is the ultimate logic of the entire AI bubble. Venture capitalists frantically pour money in, creating the AI bubble. The bubble spawns thousands of cash-burning AI startups like Perplexity. When the bubble bursts, due to a return on investment crisis or competitive shocks, these thousands of companies go bankrupt. Their true assets, top AI engineers, valuable datasets will be sold off at dirt-cheap prices. At this point, who is standing by with tens of billions in cash ready to pick up the pieces? Precisely those cockroaches, Microsoft, Google, and Amazon. Do you understand? This VC-driven AI bubble is, objectively, burning money for tech giants to conduct external R&D. The bursting of the bubble is not a threat to these giants, but a once-in-a-lifetime industry consolidation opportunity. So, we return to the original question. Are we in 1995, at the beginning of the revolution, or 1999, at the peak of the bubble? The answer is, we are simultaneously in both eras. In terms of technological potential, we are in 1995. Cathie Wood is right, AI is a profound revolution. In terms of market psychology, we are in 1999. Jeremy Grantham is also right. A 180 times price-to-sales ratio and throwing money at companies with no revenue is irrational exuberance. We are in a contradictory state where a 1999 valuation bubble is built upon a 1995 technological revolution. That 2000 playbook is not only outdated but extremely dangerous. It's fighting a new war with an old map. It is completely blind to the new types of risks in 2025. It doesn't see the trick of circular financing. It doesn't see the risk of return on investment collapse. It turns the safest strategy of selling shovels, which is strategy 1, into the most dangerous strategy. The technological revolution is real, but the market's frenzy is also real. Friends, do you think it's 1999 or 1995 now? Leave your year in the comments section.